Welcome back to the channel. If you're looking for a company that's not just riding the AI wave, but is fundamentally building its infrastructure, then you need to pay attention to Nebius Group. Their Q3 2025 earnings report wasn't just good, it was a blockbuster that signals a massive shift for this company. Let's break down the numbers and see what it all means for investors. Nebius Group, NBIS, is a technology company that provides a comprehensive cloud computing platform and related IT infrastructure services designed primarily for businesses and developers. Operating through its core brand Nebius, the company offers a wide array of products, including virtual machines, GPU-accelerated computing, managed databases, Kubernetes engine, and secure object storage, aiming to be a competitive alternative to larger hyperscalers. The business model focuses on delivering a user-friendly, scalable, and cost-effective cloud ecosystem that supports everything from application development and data analytics to artificial intelligence and machine learning projects. Founded by a team with extensive experience in building major tech enterprises, Nebius Group strategically targets the European market, emphasizing robust security, compliance with local regulations, and a strong commitment to sustainable data center practices to empower digital transformation for its clients. First, let's talk about the headline number: growth. Nebius reported Q3 revenue of $146.1 million. Now, on its own, that's a solid figure, but context is everything. That number represents a staggering 355% increase compared to last year, and a very healthy 39% jump from just the previous quarter. The real story here is the driver of that growth. A whopping 90% of that revenue, so about $131 million, came directly from their core AI infrastructure business. That segment alone grew by roughly 400% year over year. The demand is so intense that the company completely sold out all of its available capacity in the quarter, heavily fueled by clients scrambling to get their hands on the latest NVIDIA Blackwell GPUs. But the past quarter is only part of the story. The future guidance is what truly turns heads. Nebius secured not one, but two landmark industry-shaking contracts. First, a $3 billion AI infrastructure deal with Meta, spanning 5 years. And second, an absolutely massive contract with Microsoft, valued between $17.4 and $19.4 billion. We're talking about a potential $20 to $22 billion in contracted future revenue. Management noted that the revenue from these behemoth deals will really start to ramp up in 2026. This is the foundation for their mind-blowing guidance for next year. Now, with all this growth, is the company profitable? Well, it's a mixed but improving picture. On an operational basis, they are getting much closer. The adjusted EBITDA loss narrowed dramatically to just $5.2 million, down from a loss of $45.9 million a year ago. For their core AI business, the EBITDA margin expanded to nearly 19%, showing they can be profitable as they scale. However, the net loss from operations widened to $119.6 million. This is largely because they are spending massively to keep up with demand. Capital expenditures skyrocketed to $955.5 million in the quarter alone as they build out new data centers and secure more power capacity. Their goal is to have 2.5 gigawatts of power contracted and up to 1 gigawatt connected by the end of 2026. This aggressive investment is the price of admission to compete at this level. So, where does all this leave us for the investment thesis? The guidance tells the story. For 2025, they reiterated revenue of $500 to $550 million, which they are on track to hit. But for the end of 2026, they are projecting an annual recurring revenue, or ARR, of $7 to $9 billion. That's not a typo. We're looking at a potential 15x increase in their run rate business over the next year and a half. To fund this hypergrowth, They announced an at-the-market equity program to raise capital by selling up to 25 million shares, a move investors should watch closely. The overall tone from management was overwhelmingly positive. Strong execution, more contract wins expected, and high confidence in hitting these ambitious targets. They are clearly balancing explosive growth with a focus on future margins and disciplined spending. Let's discuss why everyone is so excited. The bull case for Nebius is incredibly strong. First, explosive growth. In their latest quarter, revenue surged an incredible 355% year-over-year. This isn't just hype. It's driven by massive, long-term contracts with tech titans. We're talking about a $3 billion deal with Meta, an even larger agreement with Microsoft valued between $17 and $19 billion. These deals secure revenue for years to come.
Second, they're in a massive capacity expansion phase. They plan to increase their data center power capacity to a staggering 2.5 gigawatts by 2026. This is how they plan to become a leading AI cloud provider and meet the insane demand, which is reflected in a growing pipeline now worth $4 billion. Because of this, many analysts see significant upside potential, with some predicting up to 75% growth over the next 2 years, calling it a preferred pick in the AI infrastructure space. Now, let's flip the coin. For all its potential, Nebius faces some serious challenges that investors cannot ignore. The biggest immediate problem? Capacity constraints. They simply don't have enough data center power right now to meet all the demand. This is a classic good problem to have, but it's a problem nonetheless. To solve this, they're spending big, really big. Their capital expenditure guidance for 2025 has been raised to nearly $5 billion. This aggressive spending poses execution and cash flow risks. If they stumble in building out this infrastructure, it could hurt them badly. And how are they funding this? Partly through an at-the-market equity program for up to 25 million shares. This could dilute existing shareholders, meaning your piece of the pie gets smaller. Finally, the stock trades at a very high PE ratio of around 114. This means the stock is priced for absolute perfection. Any sign of growth slowing or a broader macroeconomic slowdown in AI spending could cause significant volatility and a sharp pullback. Overall, Nebius Group is a high-risk, high-reward bet. It's positioned directly in the path of the AI tsunami, with contracts from Microsoft and Meta that are the envy of the industry. The growth story is undeniable. However, this is not a set-and-forget investment. It's a story stock where execution is everything. You must be comfortable with the risks, the massive spending, the potential for shareholder dilution, and the high valuation that demands flawless performance. If you believe Nebius can successfully build out its capacity and maintain its hypergrowth trajectory, the potential upside is substantial. But if you're risk-averse, the volatility might be too much to handle.
The consensus on Wall Street for Nebius Group is overwhelmingly positive. Major firms like Goldman Sachs, D.A. Davidson, and BWS Financial all maintain buy or strong buy ratings on the stock. According to aggregators like MarketBeat, there are virtually no sell ratings in sight, which tells us the expert community is fundamentally optimistic about its future. Where do analysts think the stock is headed? The price targets are where things get really interesting. We're seeing a range from around $105 on the conservative end all the way up to $161 from the most bullish analysts. What does this mean for you? Well, based on current prices, these targets imply a potential upside of anywhere from 10% to over 40%. That's a significant growth runway that analysts are projecting, making NBIS a standout for its potential returns. The bull case is powerful. Nebius is a leader in a transformative market, has secured long-term customers, and has massive growth potential, with analysts seeing a clear path to 40% upside. The bear case is one of prudence. The stock is expensive, it costs a lot to grow, and any misstep in execution could be punished by the market. The bottom line? The analyst consensus leans strongly toward buy. They believe the company's growth story and its position in the AI ecosystem outweigh the current risks. However, this is not a set-and-forget stock. It's one you buy with the understanding that it may be a volatile ride and you need to keep a close eye on its quarterly execution. What do you think? Is NBIS a buy for you? Let me know in the comments below. Thanks for watching. If you found this useful, smash that like button and subscribe for more deep dives. See you in the next one.